The broadcast is now starting.
Hi there, it is Mark Sebastian, founder of Option Pit, and this is Options Made Easy. Reminder, this is for education purposes only. Shouldn't be considered investment advice. Options have risk. There is a thing about risks and blah, blah, blah on options that you can get at, you call 1-800-OPTIONS, they'll send it to you. Hey, this is part one of what is actually a 6-part series called Options Made Easy. This is an introductory. It's going to build real low and then crescendo. But what our goal is to really teach you all kinds of great stuff about how to trade options a little easier than most people make it for themselves. If you want to sign up for this course, I'll explain kind of more later why. But if you want to get ahead of the curve, it's optionpitmembers.com/EZO. And it's $197. Use code 25_off, OFF, and it'll take $25 off the course. So let's get moving. So what we're going to talk about is a little bit of options exist, some basic option terminology, the use of options stacked together for directional trading, and buying versus selling of options. Real simple. So if I were going to use one word to describe options, what word would I use? And you guys should know this. What word? Awesome. I like awesome. But it's not awesome. Hedge, that's a technical term for what they are. Smart, yes, Lena, they are. Choice, I like that. Derivament, yes, I don't know about the derivament. Leveraged, I would not use leveraged. If I was going to describe options one word, I would use the word options. Yes. No. Flexibility, I like. I would use the term insurance because so the closest that we saw was hedge. But that's what they are, is they're a hedge. They're insurance. All right, and what is insurance? All right, we're going to talk about that. Calls insure against the loss of dollars on a long position. Puts insure against the loss of dollars in a short position. Real simple. There you can see how a long call works. Right? So on a long call, you can see you pay, this is the cost of the call, all this area. All right, but in return, you can't lose below this area. Right? There's a cost for it. And that's how that works. A put, very similar. Similar cost analysis, right? Here is all of my cost. Right? But here is where my risk is limited. My risk is limited. My risk is eliminated. So that's how you can see options work, right? You've got the cost and you've got the insurance. So you can see calls insure against that loss on a rally or on a sell-off, and puts insure on a short position. The price of the option is the price of the policy. If I buy one option for $5, it's a $500 option. It's a $500 insurance policy. All right, so when I buy options, I'm buying an insurance policy just like when I insure a car, my house, or my life. When I sell options instead of buying, all right, when I sell options, I become the insurance company. I fixed that. I'm sorry, folks. You're right. That is awful. I fixed that. That makes me mad. There. Because look, it's right there, insure. All right. All right. What does atomic stand for? That is the one-man insurance company. So when you sell options, you're becoming a one-man insurance company. How many of you like to sell puts? How many people here like to sell puts? You're an insurance company. You're a personal insurance company. That is what you're doing. You are selling insurance to someone else. All right. So that and when you buy, someone said, but I don't buy stock. So how is a call insurance? Well, if I buy a call instead of buying stock, then my downside is limited. And I paid for it. I bought insurance. Right? Going back, it's all about the fact of this. If I buy a call instead of a stock, I'm paying a price, right? And in return, I'm limiting my loss. All right. So a couple of questions here we need to ask ourselves. Do insurance companies last forever? Do insurance policies last forever? No. So if I cancel a policy, do I get all of my money back? Nope. So the thing to remember is that options, like all insurance, decay in value. All right. We sometimes call this theta in the business, but really you can see it like this. All right, here is the insurance policy today, its value at the money. Here's at the money. And what I want you to notice is this, see this is P&L, profit and loss. And you can see you can see kind of the dates and times. There's an old image. And if I buy a policy today, in August 15th, and this light blue is September 5th. So if I buy the policy now and I sell it on September 5th, and we're still right at the exact same stock price, I lose about $600. That is that insurance policy losing money, losing value. All right, this is a chart of at the money option premium decay, or theta. And if I buy a policy up here, you can see it's pretty linear for a very long time. Every day you're losing about the same. But then starting right about 30 days to expiration, it really stops being linear. For an at-the-money option, they lose a third of they lose a third of their value between day 30 and day 8, and they lose their final third of value from day 8 to 0. So policy costs. Are all policies the same cost? Do all policies, if I call up Geico and Nationwide and Farmers, bum, 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 will they give me the exact same quote? Will they say, oh, no, they won't. Why? Well, for them, it's because their insurance pool is different. All right. So just like when you're buying auto or home or life, it's good to shop for insurance. So just like any insurance market, prices can be too high, they could be too cheap, or they could be just right. Insurance markets, believe it or not, insurance policies can be wrong. There's some famous cases of insurance companies screwing up pricing. I think notably State Farm and hurricane insurance. It's an interesting read. So the key to options is to figure out whether that is the right policy. What is that policy cost? Is it the right cost? So insurance companies right. Insurance companies use tables to figure out how much to charge you. They look at their risk pool and they look at how much it costs for you all right, and where you fall on the risk table, and they give you a price. All right. Now, do I have a neat actuarial table to figure out value for my option? No, there are no actuarial tables for options. However, they have something that calls volatility. We call volatility, that's the insurance risk. And that creates the size of the premium over parity. Parity means an option, a stock is $30, and the $25 call has to be worth at least $5. Otherwise, it's too cheap. That's premium over parity. That's true. So here's a good image of premium over parity. So let's look at the 220 strike. All right. Apple is 228.36. And my option is 10.45, right? You look right there. So the 220 calls, 228.36 minus 220 is $8.36. That is parity. Well, the option is actually $10.45, right? So $10.45 minus 836 is 209. So there's $2.09 of pair of risk premium or insurance value in that 220 call. The premium over parity fluctuates on top of decaying. So it decays, but it also can go up and down. All right, the premium over parity fluctuates. As volatility increases, premium over parity increases. As volatility decreases, premium over parity falls. This volatility that affects the premium over parity, is called implied volatility. That's what the market thinks the insurance value should be. Implied volatility is a free market price of insurance on a stock or index. It reads like a number, but is really a percent. Apple volatility of 20.20 is actually 20.2%. All right, so let's talk about implied volatility indexes. So how many of you, what main broker do you guys use for the most part? What's your guys' main broker? So I'm seeing a combo of like TradeStation, Thinkorswim, IB, Fidelity, Lightspeed, TradeHawk, whole lot of different ones. Not all of them have really good implied volatility charting so that you can track what the cost of your, so that you can track what volatility is cheap or expensive. Some of them don't. The good news is SIBO and several other exchanges do list a lot of IV indexes, implied volatility indexes. That's what IV stands for. Implied volatility indexes. The most famous is the VIX. They call VIX the fear gauge. It's the fear gauge. It's not the fear gauge. All right. But what it is the insurance gauge. How much does it cost to insure a portfolio? Now you could argue that when it's going up, that means the market is scared. But I think it's better to think about it as how much it costs to buy a policy on S&P. But there are other indexes. There's indexes on gold, Russell, NDX, currencies. Then there are ones on ETFs and indexes and individual equities. There's a VIX for Apple, a VIX for EEM. I'll show you this. You've got TY VIX. That's on the 10-year Treasury. You have VX. You have EVZ is on Euro currency. VXSLV is on silver. VXGS is on Goldman Sachs. So let's take a look at a few of them. This is the VIX. No, there's not. Question is there any VIX? Do any of them have listed options? Just VIX. So VIX moves around. That blue line, that dark blue line, this guy. That is the 200-day moving average. What shape would you call that 200-day moving average? Flat. Right. And what that is to show you is that there almost is an actuarial chart. Volatility has a really good mean reverting characteristic. And so if I'm looking and I'm seeing the VIX is, this is a period of time where it may be harder to sell. Down here at the absolute extremes are not the time to be dumping VIX. And up here, or S&P options, if you will, up here is not the time to be buying S&P options. What most people are surprised by is that Apple is much the same. It's about as flat as they come. So volatility, if you're going to be an insurance salesman or an insurance buyer, recognize when those policies are cheap or expensive. Make sense? So I don't care what you want to do, covered calls, cash secured puts, spreads. If you are not looking at IV, you are leaving money on the table. There are options that should be sold and options that should not be sold. Don't sell options that shouldn't be sold. So, when we're below the mean, we can stay below the mean for a while. But that doesn't mean that you should be just dumping when things are on the lows. Don't sell options. I know it sounds silly, right? But don't sell options that you shouldn't sell. Like the snozberries taste like snozberries. All right. So let's think about it again. When are the times that I would not want to buy in Apple? I don't care if this is before earnings. This is probably not going to win. These spikes, if you will. Yeah. And it's spiking lower here. The time to sell options is like here. And really, kind of here. And here. Buying options. Again, there are times options can be a good buy, especially when IV is at super low levels. Often the best time, and I mean this, often the best time to buy is right after a strong move in a stock, after an event. Traders tend to oversell premium. Here's Apple. All right, makes a really nice move. And then what happens to the premium? You think if I bought calls here, I could have won? Would you have liked to own a call at this level on this day, at kind of this vol right here? Would you want to buy calls there? I know I would. When price is rising and volatility is getting cheaper, that usually is a good sign that a stock is going to go higher. All right, so now let's talk directional option trading. All right, directional option trading. Oops. All right, so when policies are cheap, and I think I want to buy calls and puts, when their policies are expensive, I'll use put and call spreads. In the money or at the money, that's fine. All right, just where it's priced best is usually what I would say. Well, that's what we're here to talk about. So when policies are expensive, again, use spreads. So you can also use cash secured puts or covered calls, but why? And I'm going to talk about how to decide. So let's take a look at Snap. All right. Who's heard of Snapchat? Oh, it absolutely does have to do with volatility, but it's a different kind of volatility. All right. My mom's always like, why are you always on the Snapchat? Look at you on there, checking out people's stories, sending pictures of yourself to who knows what. What in the heck is a streak? No. But quite frankly, I think that they have a terrible business plan. And after their earnings, they got a nice little bump. And then they kind of fell back a little bit. And I looked and said, okay, right here, it failed on the rally, and volatility is really cheap. So what do you think I suggested? Buy puts. And I'm going to show you this. I do a little freelance writing for thestreet.com. My guy JC, he and I are besties. So I did a trade on I did a trade on Real Money Pro, buying a put. And here it is. Real simple. Buy September 7th, 12.5 put. Trust me. And guess what? Here it is around September 7th. Not bad. All right, so let's look at another trade. Nike. What is the tool I'm using for these graphs? I use LiveVol and TradeHawk for these graphs. LiveVol Pro and TradeHawk. So, I don't know if you've heard this, but Nike's been in the news. All right, so I'm going to give you one piece of, not advice, but one of my mantras is that silly, kind of news, weird kind of headline, news-driven sell-offs and stocks are usually a fade. They have, the fundamentals on Nike are great. All right. And like Kaepernick or dislike Kaepernick, it brought them a lot of attention. So the ad worked. And yes, some people are going to boycott, but a lot of people are just going to pay attention to it. So, but even throwing that campaign out, Colin Kaepernick is not a good reason to take Nike down 4%. So what do I say? What do I do? Put spread. It was a great put spread. So let's look at this chart here, Nike. Here's where the vol's really high. And if you sold a put, you did real well. All right. I believe the trade I threw out was the the September 80, the September 80, maybe the 79, 75 put spread or something like that. And you can see this put goes from $2 down to 30 cents. So let's talk about my directional checklist. Yes. So this is the checklist that you are going to use when you're building a directional trade. What is the story? Why do I believe the direction of this underlying? If you can't give me a good reason a company's going up or down, you shouldn't be trading it. I don't care if it's technical. You can give me a technical story. Technical is probably BS, but people believe in it, so it's not, right? What is what is my directional opinion from that story? Now, next, what is the speed? All right, you're saying, what does speed mean? How fast is it moving? All right. What is the speed? So how fast are things moving? All right, then what is the implied volatility? That is, how much does the insurance cost? And now someone asked, well, what about best strike, best term, and what's the best spread? Do I do in the money, at the money, out of the money? Do I do near term, long term, what month, and what is the best spread? All right, so in this presentation, believe it or not, in 40 minutes, I covered these 4 pieces in some detail. Maybe not so much speed, but we definitely hit up these guys, and we spent a lot of time on this. So what is the speed? How fast is it moving? So now let's develop a trade using steps 1 through 4. You don't know 5 through 7, and I'm going to tell you where you're going to learn 5 through 7, and then we'll develop the trade. So, options made easy, building a portfolio of trades. In this course, I will introduce you to the beginning concepts of volatility evaluation. We will give you the tools to succeed in trading in a kind of an easy, more passive way. This is going to come with 5 60 to 90 minute courses where we're going to be teaching you our toolkit. A recording and all the education materials are included. There's homework. There's email support. All right. There's one 20-minute one-on-one session with me. That is a $200 value, believe it or not. I charge $500 an hour when I consult. I know. I'm like lawyer fees. All right. And then I'm going to throw in 1 month of Option Pit Live. So Option Pit Live, I am on just about every day for 45 minutes to an hour looking at the overall market, developing trades, developing trade ideas, thinking through, talking through. You know, if you follow OP Live and go through the Option Made Easy course, what you're going to see is me putting into action what we're teaching you. So, the course itself is going to sell in our store for $397. You get a $200 session with me, and Option Pit Live is $125. That's $725 worth of stuff, and it's $197 because we want you to take it. And if you use code 25_off, see the code right here, it'll take an extra $25 off, so it'll be $172 instead of $197. And you go to optionpitmembers.com/easy O. It's a Sesame Street. Easy O. Barry, I wish you knew me too. I'm a fan. So you go to optionpit.com/easyo and sign me up. This recording will be at the bottom of the landing page today. All right. So if you're wondering where's the replay, it'll be right here. I don't know why it's not showing up now. Yep, there it was. So now, who wants to build a trade? Somebody give me a name they like or don't like and why. SIBO? SIBO would be a fun one. Let's do SIBO. All right, so what's the story with SIBO? There is a story there. All right, I'm going to tell you my story. Here's the story of an exchange named SIBO. And it was raising 3 boys of its own, 3 trades of its own. They were SPX, VIX, and NDX. But they were all alone. Till one day when the SIBO bought bats. And they knew it was much more than a hunch. Yes, you may. That this too must somehow form a corporate entity. That's the way they all became SIBO Global Markets. All right, so now the stock has recovered from the real lows of VIX, but I want to show you, take a look at volume in VIX itself. There it is. Average daily volume has really fallen off. All right, average daily volume is off. So, and futures volume is off. You know, if you look at futures, you know, they did 88,000 in SEP and 80,000 in OC. Not great. So, I'll be honest, I don't think the stock is going to do great over the next few months. When do they have earnings? Earnings are going, oh man. Oh, I want SIBO, sorry. SIBO. Earnings are going to be in Noviembre, as they would say. And if you look at the stock chart, volatility, not high, not low. Certainly higher than where it's been the last few weeks. But obviously it can get much higher. But, you know, looking at it over, I want to look at it from 2 years. You can see, actually, it's pretty well elevated, considering where VIX is. If I ran this vol relative to this volatility relative to VIX, you actually can see the correlation. All right, so I think the stock is not going to go up because volumes are kind of flattish and volatility is kind of high. And finally, let me look at the speed here. I'm going to add realized volatility. Starting to ease off. About even with vol. So if I was going to build this trade, I would probably go to September. You know, if I want to see, if I pull up live vol, I kind of like October. I'm going to do October, 38 days. It's trading 104. And I'm going to do the 100 105 put spread. Whoops. The 105, 100 put spread. And you can see the market is 140 at $2, mid price 170. And I would put that out. So that's a name I like. All right, folks. Again, I want to encourage you to take this class. This 25_off coupon, if you want this whole package, you need to order before Friday. So please get that moving. All right, everybody. I want to thank everyone for coming. It's good seeing you. Have a great day.